All right, everybody, welcome back to another episode of AWM Insights. We're finally drawing to a conclusion. Seems a little premature given the election isn't till the end of the year, but we're already tired of talking about it. So we'll put a little bit of a bow on it for the time being. I'm sure we'll, with the excitement of the election that's coming, we're gonna bring this back up at some point, but. We'll go ahead and beat this one to the death here and wrap it up. And really what we want to focus on is putting a bow on this concept of really not voting with your dollars, but vote with the ballot. At the end of the day, you know, as we've mentioned in past few episodes, it's silly to think that the president isn't going to have, or, you know, Congress or any other elected officials are not going to have some sort of impact on the economy, even the markets, but really that the data just supports you don't know when, right? And so, or in which way. And I think we've had recent examples of that. We can go back in recent memory, and I think I hit on this in a past episode, but you think about Trump being elected. That was a big surprise to a lot of people, maybe not to some. But I think you could have guessed either way on what markets would have done. And I think a lot of people were surprised about what markets actually ended up doing, and probably on the flip side when President Biden was elected. So, yeah, I think just any kind of concluding thoughts from you, Justin, as we kind of put a bow on this?
Well, I'll go back to just some core tenets of how markets are structured. We either talked about this last week or the week prior. They're incredibly complex. The election and who is in office, the office of president, who is in control of Congress, those are variables that influence market outcomes. Predicting how, to your point, is incredibly difficult in isolation, let alone when you factor in all these other variables that are digested on a daily basis. Markets probably take some sort of, on the magnitude, some sort of amount of information, you know, in the trillions, if you will, depending on how you define it. But it's just incredibly complex is the point. And this is another variable that goes into the market pricing, market functioning equation, and not only predicting the future first and foremost, but predicting how the market is then going to digest that information is incredibly difficult. This is a unique event, right? Now it happens every year, every 4 years, so it's not unique in that aspect. It's unique in the sense that, especially given in the time frame we live in, the time we live in, it's incredibly charged. It's really going to challenge the behavioral side of investing, probably more so than it has in the past, or maybe similar to how it has in the recent past, but how it has traditionally, excuse me. So those are some core things I definitely want to hit on and go back to. As we leave this topic, right? Remember these things. Markets are incredibly complex. They take into account all sorts of information, good, bad, and different. Guessing how markets are going to digest that information is very, very difficult. And guessing what that information is actually going to be is really, really, really difficult. And then combine that with this really charged behavioral environment that we're entering into, that we've already entered into, right? It's going to be a challenging year, but reacting to that is not what we should do. Our good friend Brian Kane had a recent podcast, and I think there's an analogy here somewhere. He said he called out a number, 153. It's the average number of plays in the average NFL game. How many plays you actually talk about after the fact? It's, you know, a dozen, maybe a half dozen, probably in all likelihood. Take the Super Bowl we just had, right? There's probably right. 4 or 5 that really were like meaningful and stuck in people's head. The markets are no different. You know that every day the market's going to be open, or every weekday, right? Every non-public holiday, markets can be open. Generally, you have a 50-50 probability if it's going to be up or down. The magnitude doesn't, is different. But then over time, you know that it's likely going to be up. We have an expectation that we're going to have a higher return. But knowing when those big days happen, the 5 or 6 or whatever, the very small number out of the entire calendar, when those big days happen, is incredibly difficult. And so you don't want to miss out on those. It's incredibly damaging when you do. You miss the big plays, right? You miss winning the game, if you will. And you can apply that analogy directly to investing. Election years are no different. The same principles apply. And I think that's really, really the takeaway, especially with that headline you hit on. Vote with your ballot, not your investment portfolio.
Yeah, and I think that's just such a good thing to remember. And I think, the other thing that hit on me when you were talking there is just the short-term nature of all of this too, right? Like you're talking about, a 4-year presidential kind of in office run, at best 8 years. That's still a pretty short window in the scheme of investing your money. And so to bet on these timeframes and how things are going to move, really you're not making an investment decision, you're making a trading decision. And the data still doesn't support a really smart trade one way or the other. And we're talking about like if you were making a broad market trade, I think I would also caution people into, hey, one party is going to favor a certain sector or another sector. Think about how that needle in the haystack starts to come down and how tricky that trade can end up being. So you're going to hear a lot of this. Hey, defense is going to benefit because of this, or financial sector is going to benefit because of that. If this person's in or this person's out, just encourage everybody to tune out that noise. Remember that your financial structure is really set up for the long term, right? This is why we identify your priorities. This is why we bring it back to creating a very highly customized portfolio for you, tax efficient, et cetera, is that we don't have to worry about all this stuff in the really short term. We build it so that way we have this boat that kind of will always float. And so at the end of the day, we hope this helps to put some things into perspective. We'll talk about it again later in the year because you certainly are not going to be immune. I don't think anybody is from the noise that we're about to hear. But again, just focus on that financial structure. Reach out if you have any questions. We'd love to talk to you about all of this stuff and answer any questions you have. But until next time, own your wealth, make an impact, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.